the Japanese crisis happening sooner. In fact, the Japanese crisis may be the catalyst for our crisis. It may be the pin that pricks our bubble. The Japanese bubble popping ends up pricking the even bigger U.S. bubble.
Peter Schiff believes the next major threat to U.S. markets may not begin in America. His warning starts in Japan, where the yen has fallen to levels not seen in decades while government bond yields push into unfamiliar territory. But the real concern is what happens next. Japan remains deeply connected to global capital markets and holds enormous exposure to U.S. assets. If Japanese rates rise sharply, or the yen crisis gets worse, Schiff believes money could rush home, putting new pressure on treasuries, stocks, and an already heavily indebted U.S. economy. And according to him, Japan may reach its breaking point first.
The bigger problem is they're going to keep rising because the U.S. is headed for a fiscal crisis. Our deficits are running out of control. The market is losing an appetite to finance, to the willingness to finance the debt. That's why they're demanding higher interest rates. But higher interest rates weaken the economy. Higher interest rates cause our budget deficits to rise because it means the government has to spend more money it doesn't have to pay interest on the debt. So as interest rates rise, that causes a higher deficit, which causes interest rates to rise more because the bigger the deficit is, the more investors are worried that the Fed is going to have to create inflation to service it, which means you don't want to own the debt because it's going to be debased. So we get in this vicious circle where monetary policy, interest rate cuts are no longer effective fiscally because of the immediate impact that higher interest rates have on the fiscal situation of the United States. Now, so far, the dollar has held up. In fact, the dollar index was up a little bit on the week, so it didn't go in the same direction of gold. But I think ultimately the dollar is going to decouple again in the same direction, and we're going to start to see the dollar falling when interest rates rise. Right now, the dollar gains strength from these higher rates because supposedly it's indicative of the fact that the Fed is, going to hike rates, or it's supposedly going to be good for the dollar. But I look at rising interest rates as a repudiation of the dollar, of lack of willingness to loan dollars to the United States at rates that we can afford to pay. It's part of the de-dollarization trade. And ultimately, the dollar should decouple and start to fall as bond prices rise. And when that happens, that is going to accelerate the crisis.
That feedback loop is the key to Schiff's warning. Higher Treasury yields aren't happening in isolation. With federal debt already enormous, higher borrowing costs can increase interest expenses, which can make future deficits harder to control. But Schiff's argument becomes much more dramatic when another major source of global capital enters the picture, because the pressure he sees building in Japan could collide with this U.S. vulnerability at exactly the wrong time.
Japan. Because Japan has a similar problem. It's not identical to the United States. And in many cases, our problem is worse. Superficially, people may not realize that because of the Japanese debt to GDP being higher. But that's just one aspect of it. There are a lot of other aspects that actually stack up against the United States. But as far as the timeline, we could see the Japanese crisis happening sooner. In fact, the Japanese crisis may be the catalyst for our crisis. It may be the pin that pricks our bubble. The Japanese bubble popping ends up pricking the even bigger U.S. bubble. In fact, when you look at the currencies, the Japanese yen fell to 163.8 against the U.S. dollar. This is the lowest exchange rate for the Japanese yen in 40 years. The last time the yen was this low, where you can buy this many yen for $1, was 1986. Now, yields on Japanese government bonds have also been rising. And I've been talking about this. I've been warning about it since before the movie even started. I remember when the Japanese government drew a line in the sand on the 10-year JGB at 0.5%, 50 basis points. And I said that there's no way that they're going to hold that line. I said that yields are going to go to 1%, then 2%, then 2.5%, then 3%. Well, we're at 2.8 now. This is the high that we've been since 1996, 30 years since the Japanese had to pay 2.8% on a 10-year. But of course, Japan hardly had any debt 30 years ago. All of this debt has been accumulated based on this asinine policy of artificially suppressing the yen and trying to generate inflation on the theory that this would help exports. By weakening the yen and keeping interest rates artificially low, they can export more to the United States. Well, that strategy has completely backfired. And I'm going to get to that in a minute. I want to continue to talk about the Japanese government bond market. The yield on the 30-year JGB is almost 4% right now. That's really unheard of in Japanese history. This is the highest yield ever. We closed at 3.98%. Now, the reason it's not a 30-year high is because Japan didn't even issue 30-year government bonds 30 years ago. They didn't start issuing them until 1999. And since the beginning, this is the highest these bonds have ever been. The reason that this is so problematic for Japan is because of the enormity of the debt that they have. Their debt to GDP ratio is above 200%, and they're currently running annual budget deficits that are about 2% of GDP. Despite all this, and despite the weakness in the yen, and this is the reason that the yen is weak, is the policy rate in Japan, which is the equivalent of our Fed funds rate, is still at 1%. 1%, they've barely raised interest rates. That is where the crisis is going to come, because either we're going to get a significant increase in the policy rate soon. They're going to have to take the rate up maybe 3%. I don't even know if 3% is high enough, but that would be a start. If they just go to 1.25%, 1.5%, they're going to fuel the fire. So either they're going to act aggressively and we're going to have a crisis in Japan that's going to spill over into the US, or they're going to be too timid and we're going to have a different sort of crisis that is also going to spill over into the US.
And that creates the dilemma. If Japan tightens aggressively, higher domestic yields could make Japanese assets more attractive and encourage capital to return home. But if policymakers remain too cautious, continued pressure on the yen and Japanese bonds could create a different kind of instability. Schiff's argument is that the paths are different, but the potential transmission back into global markets is what U.S. investors should be watching.
But Japan has two choices. Do the right thing and force stocks to go down, bonds to go down, force a recession. But what would the response be in America if the world's third biggest creditor nation, all of a sudden interest rates are spiking, contractionary fiscal policy, recession? They're going to repatriate. A lot more money is going to come into Japanese government bonds because the Japanese are going to buy their bonds at higher yields. They're going to put money in the bank in Japan to earn higher yields. They're going to have to cover losses on investments. It's like a big call. And the yen is going to soar. Under this scenario, the yen is not only going to stop falling, the yen is going to reverse, and that's going to totally blow up the yen carry trade. So this is going to send shockwaves throughout the world that will particularly be felt in the United States. And in fact, part of the Japanese government doing the right thing, it's not just Japanese investors that are going to sell U.S. assets, including Treasuries. The Japanese government owns over 1.1 trillion in Treasuries. The Japanese government is the biggest owner of U.S. Treasuries in the world. So if the Japanese government is doing the right thing, one of the things they need to do to shore up the yen is pay down some of their debt. Well, how do they pay down their own debt? By selling our debt. And that also helps with the yen. Now, they'll give up the income that they're earning on U.S. government bonds, but that's not that much. And in fact, if Japanese bonds rise, they may be able to have the same income on those bonds, right? As those bonds are maturing and they get higher yields. So, it's going to be a win for the Japanese to dump our bonds. Well, that's a huge loss for us when that happens. So the stock market here could crash, the bond market, the economy, we could have a financial crisis that starts in Japan. Now, maybe the Japanese don't do the right thing. Maybe they just leave interest rates alone, or maybe the Bank of Japan just goes up to 1.25. That's not going to be enough. You could have a crash in the yen. Now, that's not going to immediately drag down the dollar, but it's going to crash the Japanese bond market, which is going to have implications for the US bond market and the Japanese stock market. And if that happens again, a big repatriation, a big margin call, the Japanese are going to be selling assets all around the world, especially in the US, where they have a lot of assets. So either way, we can have a big problem in the US. And what's the Fed going to do? Obviously, they're not going to hike rates either way, especially if the dollar is strengthening based on a collapsing yen. But even if it's weakening, they're going to have to put a floor beneath the market. They're going to have to buy all the treasuries that the Japanese and everybody else are dumping. So we're going to have a crisis either way, regardless of whether Japan does the right thing or the wrong thing. It's a problem for Japan, and it's ultimately going to be a bigger problem for us. We are more dependent. Even though we have a smaller debt to GDP, we are less able to service it, and we have the problem of being a debtor nation. We are not a creditor nation. The U.S. government doesn't have a lot of wealth other than from the very, very rich, right? You got the 1% of the 1%, but the middle class Americans don't have the resources that the middle class Japanese have, which is why we're even less likely to do the right thing and more likely to get hit with runaway or hyperinflation. But the Japanese may reach that decisive moment even before we do. But then it'll be just like dominoes. It'll start there and it will quickly morph to the United States.
That's the larger warning behind Schiff's argument. Japan doesn't have to trigger a crisis exactly the way he predicts for the risk to matter. The bigger issue is how tightly connected sovereign debt, currencies, interest rates, and global capital flows have become. If Japanese money begins moving home while U.S. borrowing needs remain enormous, pressure could appear in places investors aren't expecting, whether Japan becomes the catalyst or not. Schiff believes the vulnerabilities are already there. The question is what happens when one part of the system finally forces the others to adjust.